You put $12,000 into your retirement this year, and then the first statement shows up, you go looking for your money, and the number sitting in the little box is 0. Not down a little. Not, the market had a rough year. The market was fine. Your money, it just isn't there. Because a big chunk of that 12 grand, somewhere between half of it and almost all of it, went to fund somebody's commission the day you signed. You got the paperwork, they got the paycheck. And here's the part that gets me. Nobody broke a law. There's no fraud here, nobody's going to jail. It was all disclosed. It's sitting right there in the packet they handed you, on a page they turned past pretty quickly. Not the fine print even. Fine print at least has the decency to look guilty. This is the nice page, the one with the chart going up. Right now, today, somebody's at a kitchen table nodding along to this exact pitch, about to sign the exact same thing. Maybe it's a friend. Maybe it's you, and it already happened, and this is the video that's going to sting a little. Either way, there's a number they showed you, and there's a number they didn't. And the gap between those two numbers, over the life of this thing, is bigger than most people's cars. We're going to go find it. Nanaksa. So let me back up and tell you how anybody ends up here, because it's not stupidity, it's the opposite. It's usually the responsible ones who get sold this. You're, 50, 55. You've done okay. You've got a little money. You've got a 401k that feels thinner than it should. And somewhere in the back of your head, there's this low hum of, I don't think it's enough, right? Everybody's got that hum. And then somebody brings you a solution. And it's rarely a stranger in a bad suit. It's a guy from church. It's your brother-in-law who got into finance, 11 weeks ago, and already has business cards. It's somebody who calls themselves an advisor, and technically they are, but the thing they're actually licensed to do is sell you this, and they've got a name for it. Tax-free retirement. Be your own bank. Which sounds incredible, except you will not be your own bank. The insurance company stays the bank. You just move to a worse branch. This is what wealthy people use. That one works every time, by the way. The second you tell somebody the rich have a secret account, they want in. And then they show you the page. Look, I've seen the page. It is a beautiful page. It's got a line on it, and the line starts at 0 and it just goes up. Smooth. Every single year. 6%, 7%, no bad years, no red, no scary dips, all the way up to some gorgeous tax-free pile of money at 65. It's got your name printed at the top, which does something to your brain. It stops being a sales sheet and it starts being your future. That page has a name. It's called an illustration. And you want to remember that word because it is the whole game right there. Not a statement. Not a guarantee. An illustration. Which is the word we use for the drawings in a children's book. And it is doing the exact same job here. It's the sales projection. Drawn at the rosiest number they're legally allowed to draw. And I say legally allowed for a reason, because here's a thing that actually happened. The regulators had to step in on these. A few years back, the people who write the rules looked at how these companies were drawing that pretty line and the returns they were showing and basically said, you can't back that up. The math underneath doesn't support the picture on top, so they tightened it twice. Sit with that for a second. The projection was so optimistic that it needed a law to calm it down. That's the page your future is printed on. Okay? So let's actually open this thing up and see how it works. Because once you see the moving parts, you can't unsee them. Start with year 1. You put in your $12,000. Where does it go? Some of it buys the actual insurance, the cost of keeping you covered, and that's real, that's fine. Some of it goes to the company's fees. And a big slice of it, in that first year especially, goes to pay the person who sold it to you. On a lot of these policies, the first year commission is somewhere between half and all of your first year's premium. So your cash value, the part that's supposed to be yours, the part that's supposed to be growing, year 1, it's basically nothing. A couple $100 if you're lucky. That's not a glitch. That's the design. and it doesn't fix itself the next year or the one after. Here's the thing nobody says out loud at the kitchen table. On a normal one of these, it can take 10, maybe 12 years before your cash value even climbs back up to the total amount you've paid in. Call it a decade plus just to break even, meaning if life happens, if you lose the job, if the roof caves in and you need to stop paying in year 7, year 8, you can walk away from this investment with less money than you put into it. There's even a penalty for leaving early. They call it a surrender charge, which is a fantastic name, honestly, because that's exactly what it feels like. Now, the newer version of this, the one with the fancier pitch, it's called Indexed Universal Life, IUL. And the hook on that one is genuinely clever, so pay attention. They tell you, you get the stock market's gains, but none of its losses. If the market's up, you win. If the market crashes, you're protected, you get 0, but you never go negative. And you're thinking, well, that sounds perfect. Upside, no downside. Where do I sign? Here's the catch. 2 catches, actually. 1. You don't get all the market's gains. There's a ceiling. They call it a cap. So in a year, the market rips 25%, you don't get 25. You get your cap. 9, maybe 10. The market sets an all-you-can-eat table and your plate came with a lid. On $100,000, that lid kept $16,000 of your best year. The company ate it. And they can lower that cap after you've signed. You're locked in. They're not. 2, and this is the sneaky one. Those costs I mentioned, the insurance, the fees, they don't stop in the years the market's flat. So a 0 year, the one where they told you you're protected, you're not really at 0. The costs are still getting scraped out of your cash value every month. A protected year is still a year you quietly went backwards. So put it all together. What does one of these actually earn? The money that's yours, over the long haul? Even a good one, a well-built one, run by somebody who knew what they were doing? 3%, maybe 4% on a really good one. That's the real number. That's the line that should have been on the page. Not the 6, not the 7, 3, maybe 4, and only after you've survived a decade underwater to get there. So now, the obvious question. If not this, then what? And this is where the title of this whole thing comes in, term versus whole life, because the answer's been sitting right there the entire time. Step back and ask what you were actually trying to do when you walked into that meeting. You wanted 2 things. You wanted your family to be okay if you died, and you wanted to grow some money for later. 2 goals. Totally normal. The policy's whole trick is that it staples those 2 things together and then charges you a premium for the bundle, and the bundle is where the money disappears. So unstaple them. Do them separately. Watch what happens. Goal 1, protect the family. You buy term insurance. Same idea, covers you if you die, except it's just the insurance. No investment bolted on. $500,000 in coverage, 20 years, for a healthy person in their early 50s. That runs you, I don't know, $80 a month, give or take, instead of $1,000, which means goal 2 just got interesting, because now you've got the difference in your pocket. $900 and something a month that used to vanish into the policy. Call it $900, and you invest it. Nothing fancy, no secret account, just a plain index fund, spread across whatever accounts fit you, a brokerage account, your 401k, maybe a Roth if you qualify. Let's say it grows at a normal 7%. Not the market's best, not a fantasy number, just the boring long-run average. Over those same 20 years, that's about $475,000, and every dollar of it is yours. No surrender charge, no 10 years underwater. You want it, you log in, it's there. Now let's be fair and run the policy the same way. Same 20 years, same money going in, and I'm going to be generous to it. I'm going to give the whole life policy 3.5%, which, as we just covered, is a good day for one of these. That gets you somewhere around $340,000, $350,000 in cash value. And even that you can't just spend. A lot of it you have to borrow against your own policy to touch. And yeah, they charge you interest to borrow your own money, which is like paying rent to sleep in your own bed. So there's your two numbers. The term and invest road, around 475, the policy road, on a good day, around 345. That's a gap of roughly $130,000. And I want to be honest with you, that's me being nice to the policy. Give it the 3% it probably actually earns instead of the 3.5% I gifted it, and the gap gets wider. 130 grand is the friendly version. And I know what the guy at the dinner says here because he always says it. Term runs out at 72 and then you've got nothing. He's right about the date. But look at the pile. By 72, you're sitting on 400 grand of your own money. You don't need to rent a safety net when you own the ground. The policy protects your family from losing your income. The pile is your income. That's what self-insured means, and it's the ending they never mention at the dinner. That's the number they didn't show you. It was never hidden exactly. It's just on a page they never printed. Now, I need to stop and be straight with you about something, because there's a version of you this whole video does not apply to, and I'd feel bad not telling you who that is. I'm not here to tell you insurance is a scam. It isn't. There are real people that whole life is genuinely right for. If you've got an estate big enough that taxes are going to hit your kids when you pass, this stuff can be a real tool. If you've got a child with a disability who is going to need money taken care of for their entire life, not 20 years, their whole life, then permanent coverage makes real sense. Business partners use it to buy each other out. These are real, legitimate uses, and the people who need them usually have an accountant in the room when they buy. But look at that list. Big taxable estate, lifelong dependent, business succession. Is that the pitch you got? Or did somebody sell you a retirement plan? Because that's the switch. This is a product built for a few specific situations, being sold to everybody as the thing that fixes retirement. And as a retirement plan, for a regular person, it's just an expensive way to do something you can already do for less. And that tax-free part, the headline, the whole reason it sounds magic, a Roth does that. A Roth account grows tax-free and comes out tax-free, and there's no insurance company standing in the middle taking a cut for the privilege. The tax-free thing was never the secret of the rich. It was just the bait. So what do you actually do with this? If somebody's pitching you one right now, you don't need to argue with them. You don't need to know all the jargon. You just ask them one question and you watch their face. Ask them, how much of my first year's premium is your commission? That's it. However they answer that, the speed of it, the squirming, tells you everything the illustration won't. And if you already have one of these, first, breathe. Don't go cancel it this afternoon. Bailing out wrong can cost you in taxes and surrender penalties, and that's a whole other video. What you do is you request something called an in-force illustration. That's the honest one, the one that shows where you actually stand today, not the dream from the sales meeting. And you take to somebody who does not sell insurance for a living, and you let them look at it with fresh eyes. Because that's the whole game in the end. It was never that the number was hidden. It's that it was printed somewhere they hoped you'd never look. So from now on, you look. You ask what the real return is, after everything. You ask who gets paid, and when. And when the line on the page is smooth, and it only ever goes up, and it's got your name printed at the top, that's exactly when you turn the page. If this saved you from signing something, or helped you finally understand the thing you already signed, do me a favor and subscribe. The entire point of this channel is the number nobody puts on the pretty page, and there's a lot of pretty pages out there. I'll see you in the next one.